2 bars. That is all that moved through the entire COMEX silver system yesterday. Not 2,000, not 200, 2. While the world was watching prices swing, something far more important was happening in total silence. Behind the vaults, behind the paper contracts, behind the charts everyone was staring at, a signal was forming. And thousands of miles away, in China, a much bigger machine was already in motion, one that could turn this silence into the loudest moment silver has seen in years. By the end of this briefing, you will understand exactly what that silence means, and why it may not stay silent for long. Welcome back to Currency Arc Insight, the channel built for serious investors and forward-thinking entrepreneurs who read the markets before the headlines catch up. If this is your first time here, consider subscribing so you don't miss the next signal before the crowd does. Let us know in the comments where you're watching from today. On the morning of July the 23rd, analysts reviewing the latest COMEX depository report noticed something that did not add up. Across the entire silver market, one of the largest and most closely watched commodity systems in the world, only one depository showed any activity at all. The Delaware depository received exactly 2,938 troy ounces of silver. That is the equivalent of 2 standard delivery bars, nothing more. For a market that trades billions of dollars in contracts every single day, this number was almost impossible to believe. Registered silver, the portion of metal actually available for delivery against futures contracts, stayed completely flat at 96.3 million ounces. Total COMEX silver stocks ticked up by barely 2,000 ounces, landing at roughly 330.3 million ounces. In a market this size, that kind of movement is not just small, it is statistically unusual. To understand why this matters, it helps to look at what registered silver actually represents. It is the metal that stands behind every futures contract traders buy and sell. At current prices near $57 an ounce, the entire registered float is worth approximately $5.5 billion. That figure might sound large on its own, but when compared to the size of the paper market trading on top of it, it becomes clear how thin that physical foundation really is. Meanwhile, open interest in silver futures remains high. Traders continue placing bets, hedging positions, and moving capital through paper contracts at a rapid pace. Yet almost none of that activity is translating into actual metal leaving the vaults or shifting between depositories. Analysts describe this as a widening gap between the paper market and the physical market, and that gap is exactly what makes this moment worth watching closely. Historically, quiet periods like this have often preceded major shifts. When physical movement slows to a crawl while paper trading stays active, it can mean one of two things. Either genuine demand has temporarily paused, or market participants are holding their positions tightly, waiting for a catalyst before making their next move. Given everything else happening in the global economy right now, the second explanation appears far more likely. It is also worth noting that this silence is not isolated. July has already seen strong overall deliveries, with more than 45 million ounces moving through the system so far this month. That means the market is not inactive. It is simply behaving unevenly, with large deliveries happening in bursts, followed by days like this one where almost nothing moves at all. This pattern of extreme highs, followed by near total silence, often signals underlying tension building beneath the surface. For everyday investors and business-minded individuals watching precious metals as a store of value, this is not just a technical footnote. It is a warning sign. When a market this large goes quiet, it does not mean risk has disappeared. It often means the risk is simply being repositioned, waiting for the right trigger to bring it back to the surface. And that trigger may already be forming, not in New York or London, but on the other side of the world. While COMEX sat nearly frozen, a separate and much larger story was unfolding in China, one that directly connects to why this silence may not last much longer. What happens next depends on a decision being made right now by some of the largest financial institutions in Asia, and the ripple effects could reach far beyond silver bars sitting quietly in a Delaware vault. To understand what is really happening in the silver market, one has to look past the price on the screen and examine what stands behind it. Every day, traders around the world buy and sell silver contracts worth billions of dollars, yet almost none of those trades involve anyone actually touching a bar of silver. This is the paper market, and it operates almost entirely separate from the physical one. Here's how it works. When someone buys a silver futures contract, they're not buying metal. They are buying a promise, a piece of paper that represents silver, backed by an exchange rather than a vault full of bars sitting in front of them. Most of these contracts are never intended to result in physical delivery. Traders open and close positions purely based on price movement, treating silver the same way they might treat a stock or a currency pair. This system works fine as long as almost nobody asks for the actual metal. And for years, that has been exactly the case. Open interest, which measures the total number of active contracts, remains extremely high. Billions of dollars in exposure exist within the silver futures market at any given time. But behind all of that exposure sits a surprisingly small amount of physical metal actually registered and available for delivery. That number, as covered earlier, sits at 96.3 million ounces. At today's prices, that entire registered float is worth somewhere around $5.5 billion. It sounds like a significant amount of money until it gets compared to the sheer scale of paper contracts trading on top of it. The ratio between paper claims and physical backing is what analysts refer to as the leverage ratio, and in silver, that ratio has grown increasingly stretched. This is where the real risk begins to take shape. As long as most paper holders are content to trade contracts without ever requesting delivery, the system holds together smoothly. Prices can rise and fall, headlines can come and go, and the market continues functioning as normal. But the moment a meaningful percentage of those paper holders decide they want the real thing, the entire structure gets tested in a way it was never designed to handle. This is not a new phenomenon. Markets built on leverage have faced similar pressure points throughout history, and precious metals are no exception. When physical demand rises faster than physical supply can comfortably meet it, prices do not move gradually. They tend to move suddenly and sharply, often catching traders on the wrong side of their positions, completely off guard. For business-minded investors, this distinction between paper and physical exposure matters more than most people realize. Owning a futures contract or an exchange-traded fund tied to silver provides exposure to the price of the metal. It does not provide ownership of the metal itself. In calm markets, that difference rarely matters. But in moments of genuine stress, when everyone wants the real asset at the same time, that difference becomes the entire story. This is precisely why the quiet COMEX report from Part 1 carries so much weight. A market moving only 2 bars in a single day, while carrying billions in paper exposure, is a market where the physical foundation has grown remarkably thin relative to the promises stacked on top of it. It does not take a large shift in behavior to create outsized pressure on a float this size. And right now, halfway across the world, a shift in behavior is already underway. Major financial institutions are beginning to change the rules around how paper metal gets traded, forcing a decision that has never been forced at this scale before. What happens next inside China's banking system may determine whether this quiet imbalance in the paper market stays contained, or whether it becomes the spark that exposes just how thin that physical foundation truly is. While the COMEX system sat nearly frozen, a much larger story was taking shape on the other side of the world. Major Chinese banks, including the Industrial and Commercial Bank of China, the largest bank in the world by total assets, made an announcement that few Western analysts fully appreciated at the time. Starting July 24th, these institutions began shutting down retail paper gold trading entirely. For everyday customers across China who had been trading gold through paper accounts, the message was simple and direct. Close the position or take physical delivery. There would be no more sitting comfortably in a paper claim while treating it as equivalent to owning the real metal. The choice was being taken out of their hands, and a hard deadline was attached to it. At first glance, this may look like a story about gold alone, but the implications reach much further than that. Gold and silver trade within the same broader precious metals complex, and shifts in one market rarely stay contained to that market alone. When a banking system as large as China's begins forcing a hard separation between paper claims and physical ownership, the pressure does not stop at the border of a single metal. This is not a small technical adjustment either. And this is one of the largest financial institutions on the planet, telling its own customers that paper promises tied to precious metals are no longer being treated the same way as before. That is a significant statement about how seriously physical backing is now being taken, and it raises an important question for silver specifically. If paper gold is being phased out at this scale, how long before similar pressure spreads into paper silver as well? There is growing discussion that paper metal traders more broadly could soon face a form of forced settlement, where holding a contract without physical backing becomes far less comfortable than it has been in the past. Right now, COMEX data shows a market where almost nobody is requesting the actual metal. But that condition can change quickly once the incentives shift, and China's move may be exactly the kind of event that begins shifting those incentives. This becomes even more significant when placed alongside what has been happening with physical demand more broadly. China and India together represent 2 of the largest sources of physical silver demand anywhere in the world. Both countries have continued pulling physical metal into their markets steadily, even while Western paper markets have kept prices relatively contained through futures trading. That disconnect between rising physical demand in the East and subdued paper pricing in the West has been building for some time, and it cannot continue indefinitely. Industrial demand adds another layer to this picture. While solar demand has pulled back slightly, other sectors are expanding quickly. Data centers, electric vehicles, and artificial intelligence infrastructure are all increasing their reliance on silver for manufacturing. This means physical demand is not just a story about investors stacking metal. It is also a story about industries that genuinely need silver to keep operating, competing for the same limited physical supply. Put all of this together and a clearer picture begins to form. China is closing the paper gold loophole for its own citizens. Physical demand for silver continues rising steadily across both China and India. Industrial usage is expanding in the background. And yet, the COMEX system in the West continues showing near total silence in physical movement, even while paper contracts trade in massive volume. This is the environment where small signals start to matter a great deal. A market. This quiet, sitting directly beside a market this active in policy change, creates the exact kind of conditions where sudden shifts tend to happen. And the final part of this analysis will examine exactly what could happen if that shift finally arrives, and what it would mean for anyone holding silver when it does. Every piece of this story now points toward a single question. What happens when a market this quiet finally breaks its silence? And what does that moment look like for the people watching from the outside? July has already shown that silver is not a sleepy market. More than 45 million ounces have moved through the COMEX system so far this month, a number that reflects real active demand. Yet that activity has not come in a smooth, steady stream. Instead, it has arrived in sharp bursts, followed by days like the one described at the very beginning of this analysis, where only 2 bars moved through the entire system. This uneven pattern, large surges followed by near total silence, often signals that a market is not calm. It is coiled. The daily warehouse reports tell a story of extreme complacency. On paper, everything looks orderly. Contracts trade, prices move within a normal range, and the system appears to be functioning exactly as it should. But underneath that surface calm, the physical foundation supporting all of it remains thin, and thin foundations do not stay stable forever under growing pressure. One indicator worth watching closely going forward is the Shanghai premium, the difference between the price of silver in China and the price on Western exchanges. This number has quietly become one of the clearest signals of where real physical stress is building. When that premium widens, it often means physical buyers in China are willing to pay significantly more than the paper price suggests, a sign that physical scarcity is becoming a real concern rather than a theoretical one. History offers useful context here as well. Regional squeezes in silver have happened before, moments where a specific pocket of the market faced sudden, intense pressure to deliver physical metal. These squeezes have never been a single, uniform event across the entire global market at once. Instead, they tend to appear as isolated pressure points, one region's or one segment tightening sharply, even while the broader system continues operating normally elsewhere. Given everything happening right now between China's paper gold restrictions and the quiet COMEX report, another one of these pressure points may already be forming. If that pressure continues to build, the next visible sign is likely to be backwardation, a situation where near-term delivery prices rise above longer-term futures prices. This typically happens when buyers want physical metal immediately and are willing to pay a premium to get it now rather than wait. Backwardation has appeared in silver before during periods of genuine physical tightness, and it remains one of the clearest technical warnings available to anyone paying close attention. For business-minded investors and entrepreneurs evaluating how to position themselves, the lesson here is not about predicting an exact date or an exact price. It is about understanding the structural imbalance that has been building steadily beneath a surface that looks deceptively calm. The gap between paper claims and physical backing does not close quietly. When it closes, it tends to close quickly and often violently in both directions. This is why diversification across both physical holdings and other related assets, such as mining equities or precious metals funds, remains a reasonable strategy for those looking to manage this uncertainty. It is equally important to understand the difference between owning a paper claim tied to silver's price and owning the physical metal itself. In calm periods, that difference feels unimportant. In moments of real stress, it becomes the only difference that matters. The COMEX report from July the 23rd may look like a minor technical footnote to most observers. Only 2 bars moved. Almost nothing happened. But when placed next to China's decision to force a hard separation between paper and physical gold, and against a backdrop of rising industrial and investment demand, that quiet number starts to look less like nothing and more like the calm before a much larger reckoning across the entire silver market.